Welcome everyone. In the last session, we have discussed in detail the key elements and how those key elements of financial statement is identified and what are the criteria for identifying. And we even discussed about how the measurement of assets and liability can be done. Next, let us discuss the measurement of other key elements in the financial statement. Next one, measurement attributes for revenue. Revenue is measured on the basis of exchange value of the product or services of the firm. The exchange value actually reveals the cash equivalent or the present discounted value of money which is received from the revenue transactions. That depends upon the view of identifying the revenue. Either you can follow as per the cash equivalent concept or as per the present discounted value of money concept. I believe you all know the meaning of present value of money. Last class we have discussed about that. Anyway, that depends upon the view of identifying the revenue. Whatever it is, once you identify that, the revenue may be similar to the price established in the transaction. For this purpose, proper allowances must be made in order to wait for the final collection. So any amount received from the exchange of goods and services is simply known as revenue. So, the purpose of measurement of revenue relates to the present value of money or its equivalent which is finally received from the revenue transactions. But, in order to confirm the actual value of the revenue, we need to consider some important items such as returns. If there is any form of sales returns, in that case we cannot say that we have received that much amount of revenue, because so we need to consider sales returns or any type of returns happens. We need to consider that. After considering that only we can say we have received that such and such amount of revenue. Another factor you need to consider, that is discounts. Other types of reduction that may have agreed upon by the buyer and seller, and such items, that is returns, discounts, reductions, and some cases even bad debts can occur. So after considering all these items only, you can finalize that you have received such and such amount of revenue. So that is with regard to revenues that has to be recorded in the financial statement. I believe you have prepared financial statements in your plus 2, plus 1 classes, where you have prepared trading profit and loss accounts, and you might have recorded discount in the trading accounts, and those discounts has to be considered before finalizing the actual amount of revenue, because revenue cannot be fully written in the account even if there is any sorts of discounts or any sorts of returns or any sort of deductions if exist. For example, best example is whenever you record sales in the trading profit and loss account, especially in the trading account, you will record the actual amount in the amount column only after deducting the sales returns. That is the concept. So whenever you are recording the revenue part of an item or revenue item in an account, you need to consider all sort of deductions, returns, discounts, and some cases there might be bad debts. That is with regard to revenue. Next one, measurement of expenses. How the key element in the financial statement, that is expenses, are measured. Expenses are measured in terms of valuation of goods or services used or consumed. It means expense is measured on the basis of cost involved. That is a concept. If there is any sort of cash outflow with regard to any of the item, means for any purchase or for meeting any requirements like paying the rent or paying the telephone charges or telephone bill, current bill, like that. So whenever there is cash outflow with regard to any goods or services, that is known as expenses, and it will be recorded at their cost price. And how these can be measured? The most common measures of expenses are: first one, historical cost. I believe you all know what is meant by historical cost. The conventional method of measuring expenses is the historical cost concept measurement. The primary reason is that they are assumed to be verifiable since they represent cash outlays by the enterprise. They also represent the exchange value of goods and services while they were acquired by the firm. That is a concept with regard to historical cost. Whereas we can either follow the next one on the basis of current measurement, we can simply say replacement cost. If anyone is following the current measurement or replacement cost, in that case the revenue is generally measured in terms of the current price received against the product sold. So in that case, the expenses must match with the revenues and should also be measured in terms of the current price of goods or services used or consumed. Actually, the current price or current measurement or replacement cost is the current price, the existing price of goods and services used or consumed. That is the meaning of current measurement or current cost or replacement cost. Remember, if you are running a firm and if you are following the current measurement concept, make sure you have to follow the same pattern in case of revenues also, because as per the matching principles, the expenses and the incomes should match during that accounting period. It should be related to that particular accounting period. So if you are following a system of measurement in case of expenses, it must be followed in the revenues also. That is the concept. Next one, presentation of financial statement. The Indian accounting standards and IFRS, I believe you all know what is meant by IFRS, requires that any corporate body or any company should have a complete set of financial statements which comprise a statement of financial position, a statement of profit and loss, and other comprehensive income, a statement of changes in equity, and a statement of cash flows. It requires an entity to present a complete set of financial statements at least annually, so as to compare the amounts for the preceding years. So, according to IND AS 1, IND AS 1 means Indian Accounting Standards, presentation of financial statement should set out the overall requirements of a financial statement. So, what are the contents of a financial statement? You usually know that a financial statement of a company includes trading, profit and loss account, balance sheet. Okay, correct. But the actual financial statement of a company or a corporate consists of more than that. So a complete set of financial statement comprises of: first one, statement of financial position as at the end of the period. Statement of profit and loss and other comprehensive income for the period. Other comprehensive income is those income and expenses that are not recognized in the profit and loss in accordance with IFRS standards. Indian Accounting Standards, or otherwise known as IND AS, specify to prepare a statement of profit and loss and other comprehensive income for the period. But as per the International Accounting Standard 1 allows an entity to present a single combined statement of profit and loss and other comprehensive income, or two separate statements. In general sense, as per the new standard, every company should prepare a statement of profit and loss and other comprehensive income for the period. So, next one, Statement of changes in equity for the period. Another one, statement of cash flows for the period. And next one, notes comprising a summary of significant accounting policies and other explanatory informations. And finally, a statement of financial position as at the beginning of the preceding comparative period when an entity applies an accounting policy retrospectively. So, you might be confused with the 6 points mentioned here. Actually, here some of the statements are actually the other name of trading profit and loss account and balance sheet. See, statement of financial position as at the end of the period means balance sheet of the concern. Statement of profit and loss means our profit and loss account. Statement of changes in equity, actually you didn't prepare anything like that, but we will learn how to prepare the statement of changes in equity for the period. Why this statement is prepared means equity refers to the capital. In narrow sense it means capital, but in broader sense it includes capital and other returns or incomes of the owners. So anyway, why this statement of changes in equity is prepared means we need to know what is the change happened in the capital of the company. Whether there is an increase in the value of the capital, whether there is an increase in the decrease in the value of the capital, or whether there is additions that made during the year, whether there is drawings made during the year. So in this statement you can clearly identify what are the movements happened in the capital alone. That is why this statement is prepared. Previously you didn't prepare anything like that, but from here onwards we will learn to prepare. In the next module we will deal with practical cases where it requires the preparation of statement of changes in equity. Next one, statement of cash flows for the period. That means what are the cash inflows and cash outflows happened during the period. It is prepared in a statement format, and you will learn about the statement of cash flows in your higher studies. Next one, these are the statements that has to be prepared with regard to a financial statement. And the fifth and sixth are not statements. It means after the statements you can prepare various notes and other summaries with regard to the accounting policies you have followed in the preparation of financial statement, especially some specific accounting policies, and what are the treatments you have made on certain specific items. And if you have gone through any of the policies outside the IFRS standards or outside the INDAS standards, if you have followed any steps, that you need to mention that as a footnote by the end of the statements. So here these 2 points refers to those areas. One is you can add notes. What are the steps you have followed? What are the policies followed by the concern while preparing a statement? That is known as notes, comprising a summary of significant accounting policies and other informations. If you have made any significant use of any other policies other than INDAS or any of the IFRS standards, you can mention it by the end. And finally, statement of financial position at the beginning of the preceding comparative period. Here this actually means how the statement prepared by us can be facilitated in comparing the values of the preceding period. Because the main purpose of IFRS and INDAS and these convergence is comparison. Comparison means comparing the financial statement of a company with its preceding statements, or comparing the financial statement of one company with another company. So, presentation of financial statement as per INDAS 1 actually involves all these 6 areas. But we have learned only up to trading profit and loss account, balance sheet. We will learn in detail in the next module. So this is how you have to present the financial statements. Next one, principle of disclosure. The IFRS 7 standard specifically mentioned that the company who's following the IFRS standard requires to disclose information so that the interested parties may find the financial statement very useful. A disclosure is additional information attached to an entity's financial statement, usually as explanation for activities which have significantly influenced the entity's financial results. In the last slide, you have mentioned 6 activities that has to be prepared by preparing a financial statement, and within that, and the last one was adding notes, summaries about the accounting practices and policies or any actions taken by the company while preparing financial statement. And IFRS 7 mentions that the company must disclose such information so that the interested users or parties get correct information about the company. Such disclosures are important for potential investors to take decision on investment in the business. Accounting disclosure notes are included in the footnotes to an entity's financial statement. Footnote means by the end of the financial statement, by the last line of financial statement, like that. So that the disclosure should be made in such a way that it should enable the users to evaluate the significance of financial instruments for the entity's financial position and performance. That is the first main aspect of disclosure of information. We need to have a clear idea about the financial position and performance of the company. Such kind of information is beneficial for the investors or users in taking decisions. So IFRS 7 mentioned that the company or corporate that follows IFRS standards, as per the IFRS 7 standard, should disclose the information. It doesn't mean that the company has to disclose their trade secrets. The company has to disclose the useful information for the users. And then such information should also help the investors to identify the risk arising from the financial instrument to which the entity is exposed, and how the entity is managing those risks. Such informations are required by the users, not the profit or the position of the business. The profit, whether the company is earning profit, it can be identified from the profit and loss account. What is the position of the business? We can refer it from balance sheet. But it doesn't mean that the company must provide information in such a way that it should provide all the information that should be helpful for the users or investors in taking decisions. And first one is it should provide the correct financial performance and position of the business. And next is how the company is facing or dealing with the risk, how they are dealing with various financial instruments that contains risk. And IFRS 7 applies to all type of companies, and the companies disclosing the informations may be classified into 2: quantitative informations and qualitative informations, or we can say quantitative disclosures and qualitative disclosures. So first of all, qualitative disclosures describe the management's objectives, policies and processes for managing those risks. How these risks are managed, that is mentioned in that qualitative disclosures. Whereas the quantitative disclosures provide information about the extent to which the entity is exposed to risk, based on information provided internally to the entity's key management personnel. Together, these disclosures provide an overview of the entity's use of financial instruments and exposures to risk they are created. So that is with regard to principle of disclosure. As per the IFRS 7, it is necessary that every company must provide information that is helpful for the users, mainly the financial performance as well as the position. And apart from that, it also should provide information about how the activities of the business are facing risk and how these risks are managed. And the information again also provide two types of disclosures: quantitative disclosures and qualitative disclosures. So these are the aspects with regard to principle of disclosure. And also the accounting standard requires that the company following as per the standards should disclose information, and along with such informations it should make sure that the entity shall disclose in the summary of the significant accounting policies or other notes the judgments apart from those involving estimations that management has made in the process of applying the entity's accounting policies and that have the most significant effect on the amounts recognized in the financial statement. I hope you didn't understand anything from that sentence. The concept is, we have learned that as per the IFRS 7, the company must disclose informations apart from the statements. So, in those informations, it should make sure that it should provide information regarding the summary of significant accounting policies or other notes that involving estimates that the management has made in the process of applying entities accounting policies that has most significant effect on the amount recognized in the financial statement. That is, in the financial statement we will record key elements. We all know what are the key elements. So apart from the accounting policies and other procedures followed within the organization, if the company has followed any additional policies or any policies apart from the actual policies applied in the business, and implementation of such policies had led to the change in the value of any of the key elements stated in the financial statements, in that case, as a footnote information, the summary of such actions should be specifically mentioned. That is the meaning of first sentence. So that is with regard to first requirement. Next one, accounting standard requires that an entity shall disclose information about the assumptions it makes about the future and other major sources of estimation uncertainty at the end of the reporting period that have a significant result of resulting in a material adjustment to the carrying amount of assets and liabilities within the next financial year. That means we all know the assets and liabilities of 1 year will be passed on or will go on to the next year, because the value of the asset or the life of the asset will be 3 or 4 or 5 years or maybe for more than 5 years. So the value of the asset will be shown in the corresponding 5 financial statements. So while carrying over the value of assets and liabilities to the next financial year, if the company has made any sort of estimations or assumptions with regard to any of the items of assets and liabilities, and because of such estimations or assumptions, if there is any change in the value of the asset and liability, significant change in the value of the asset and liability that is to be carried over to the next year, in that case, the details of such estimations, details of such assumptions, it should be mentioned as additional information in the summary. That is another point. And finally, the entity shall disclose information about the financial position or the financial situation of the business that enables the users of its financial statement to evaluate the entity's objectives, what are the policies and what are the processes for managing capital. Such information should be provided to the users, so that they can easily evaluate what are the policies taken by the concern, what are the objectives of the company, how they are managing capital. So all these helps the users to take decision regarding whether to invest in that company or not. Only on the basis of such information the investors can properly decide that they can invest or they want to reinvest or not. So these are the aspects with regard to principle of disclosure. We will discuss about other areas in the field of convergence of IFRS in the coming sessions. Until then, go through it. If you have any queries, please do let me know.